Welcome to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.
You know, the time between the mid to end of 2023 and the middle of 2024 was such a lovely time, wasn't it? I'd open my portfolio and every time I would be greeted with good news, stable upward returns. And then come mid 2024 to now, the time we find ourselves in, we are faced with a lot of market volatility. And suffice it to say, I don't really like opening my portfolio up anymore for a sneak peek. Welcome to Smart Investing by PGIM India Mutual Fund. Everybody, Ahalya here, keeping you company until I hand over the mic to Ravi and Lisa to take us further into the conversation, the theme of which today is how investors can brace for and navigate market volatility. It is inevitable. It is always going to happen. Just like with anything, there are ups and downs even in the market. But when it comes to putting all of your hard-earned money and watching these ups and downs, now that can be the hard part. But there are some tips and tricks that can help us make the best of our investor journeys without doing much damage to our portfolios or letting the volatility get to us. So stay tuned for the conversation that is about to reach you through this podcast. It's going to be a great one. I'm really excited for all of the insights coming our way. Let's go.
The year 2020 was a roller coaster ride for many stock market investors around the world, and India was not different. The Indian market saw the single biggest fall of 12% on March 2023. It was a stark reminder of how unpredictable markets can be. The 2008 financial crisis is another classic example. So what drives market volatility? Is it fear, greed, or something else entirely? How can investors protect themselves during periods of extreme market swings? Now, if you ever checked your investment portfolio during the downturn, you're not alone. Volatility can be nerve-wracking, but understanding it can help you make better decisions. To help us unpack this, I'm joined by Lisa. Welcome, Lisa. So, what do you make out of the current volatility in the market, and how is your portfolio doing?
Hi, Ravi. Thanks. And I guess this year has started, at least for the equity markets, with some volatility. For me, with a scratchy throat. So you'll have to bear with me in this episode. But yes, I think beginning 2025, it's a good time to address market volatility and what that can, mean for the portfolio.
Yeah, I think many investors right now are worried about the volatility that we are seeing. Now, before we get into the more technical details of this podcast, let me start with a simple question. What is market volatility that we keep referring to, and what are the factors driving it?
Yeah, so, as you're saying, the last few weeks have been quite volatile for the market. And if you just see the market prices, they are trending lower, which becomes quite hard to stomach, really. Volatility is really jargon. Technically speaking, is an integral part of listed equity investments. It is a term that market participants use. But to state it simply, it's nothing but fluctuation, right? Going up and down in prices for shares or for the market as a whole. So listed equity shares are basically available to buy and sell on a daily basis at a market price, which is determined by the supply and demand of that share or the market as a whole on that particular day. Now, the triggers for this up and down movement could be macro in nature. What do we mean by that? It means, it could come from the overall state of the economy or the sentiment around it or some kind of global sentiment that's kind of being underlined in that moment. Alternatively, it could be micro triggers. What does that mean? It means anything which impacts individual companies or any events that impact a group of companies or companies within a specific sector. So let's talk about what's happening now. Currently, volatility is driven more thanks to macro events like the overall market valuation, of course, the change of leadership in the world's largest economy, and the union budget, which was presented some time back. So all these are moving parts which are impacting the daily up and down or the volatility in the market. Also, the overall global geopolitical tensions bear weight on market sentiment, and they're not going away. So, that's also contributing. So these macro factors currently are largely negative for our domestic markets, and hence the price volatility or the fluctuations are trending lower. Usually market volatility, whether macro or micro, doesn't last forever, and that's the important thing to remember. Over long periods of few years, it tends to smoothen out in favor of stock earnings and the overall state of the economy that the stock market is operating in. So how do we understand whether the volatility is high or low? An easy way to judge that is through something called the India VIX, that's VIX index. So India VIX indicates the investor's perception of the market's volatility in the near term. The index depicts the expected market volatility over the next 30 calendar days. And as a rule of thumb, the higher the India VIX values, higher the expected volatility, and vice versa. So that's what it means per se.
Yes, it's always reversion to mean. And Lisa, is this volatility permanent or temporary? And how does one manage this so that the impact on your portfolio is very less?
Yeah, so volatility is temporary, and sometimes it can, last slightly longer as well. I mean, it's a part of the market, as I had mentioned earlier. It's just that the degree of volatility differs from low to high depending on what's happening around us and, the events, macro and micro. What it does, however, it causes anxiety, especially if the volatility is kind of impacting prices to move down. And depending on what your portfolio looks like and what one's goal timelines are, etc., it can damage return outcomes as well. So to that extent, one should have some provision to protect against extreme volatile times in the market. It's not something that you need to worry about that way as long as you have these kind of provisions. And I guess that's what we are talking about today. So one of the most common ways of protecting against extreme volatile times is really to diversify your portfolio. That doesn't necessarily mean you have to have some very advanced mathematical model that you based your portfolio on. You may have it if you have access, but more than that, you need to do a very basic exercise in understanding what your goal timelines are and diversify accordingly. Now, if you just look at an equity portfolio, some studies suggest that having more than 25 to 30 stocks in a portfolio can take away the benefits of diversification. Basically, diversification will help you reduce this volatility risk that comes in. So what one should also do is that diversify into different investment styles, market caps, sectors, and include assets that have a low correlation with each other. So let me just, take an example here so that it's easier to understand. Let's say you have a few long-term goals which have at least 8 to 10 years to completion. The allocation towards those goals needs at least 70%, 80% in equity because they are long-term, right? 8 to 10 years. Beyond that, you can invest in bonds or bond funds beyond the 70, 80% or gold, and maybe even include some international equity. Now, bonds and bond funds contribute more towards stable income. And if you hold till maturity for the entire tenure of the bond or match your holding to the average maturity of your bond fund, your returns should be in line with the projections without concern. So here the concern for volatility is not there. So hence you are cushioning some bit of your portfolio. Gold prices usually don't follow the same path as equity and often move in the other direction. So when equity is volatile, gold can also provide a cushion. International equity exposure also aids diversification because other markets and economies may not be in the same position as our domestic market, right? So all these can be like a cushion, under your large equity allocation that you have, domestic equity allocation. For example, right now in India, one of the main reasons for volatility also is, the high valuations in the domestic market, right? If you look at US, There is the Magnificent Seven, the seven largest tech stocks, which were the main drivers of the rally there. And they accounted for more than half of the S&P 500, 25% return for the year. So there's something else happening there. So you need to keep adding these assets to your portfolio to cushion the overall portfolio in case of extreme volatility in domestic equities.
Yes, I think you're right that diversification really helps. And if we really focus on our goals, then we don't need to really worry about the volatility that we are seeing. But we are all human beings, and sometimes we take emotional decisions, so that could be a temptation among investors to stay on the sidelines and really look for a good time to enter the market. So what would be your advice to such investors who are, trying to predict the market?
So for individual investors, predicting the markets is really not advisable. What does predicting the market mean? You're buying at a particular time and then you are saying, okay, market's moving up and down, and you're selling. Now, selling because you feel that the volatility is high or a correction is around the corner, and then trying to re-enter later, in my opinion, is futile. The example that I always fall back on is the extreme negative sentiment we saw in March 2020. Now, we all know that was the time when COVID outbreak was being declared a pandemic and there was panic. Practically everyone was scared and unsure what the future held. It was, a period of extreme anxiety for a lot of people. And, the equity market started correcting. Many did exit the equity market because they felt unsure about how much more volatility would be there and how much more it would correct. So the markets did correct sharply in March 2020, and it continued till the last week of March. And in the entire month, I'm talking about the Nifty 50, it lost about 24%. And that's quite a lot. Now, sitting at the end of March 2020, if you had exited sometime during the month, you would be patting your back and saying, wow, you know what? I have escaped that mayhem. On one of the days in that month, the market was down 12% on a single day. It was really, really scary, right? So you would be feeling good about it. But had you exited, or had you paused your investments in panic, you would have realized that loss. So you've exited, that some loss has happened and you've taken your money out, you've realized that loss. And what you would have also missed out on is the 20% rally that the Nifty 50 saw in the coming month in April 2020. In fact, on a single day, on the 7th of April, the market was up 9%. So had you exited in March sometime, do you think you would have made that return which came in April? So in recent times, this period in 2020, March, April, was really extremely volatile. The market was up one day sharply, down the next. But if you don't remain invested, you don't get the benefit of that upside either. And more importantly, after exiting in March, it was still anxious. COVID didn't go away. The pandemic was there for 2 years. Would you have the courage to re-enter at the bottom of the market in the first week of April because you exited in March? What would have been the point anyway of exiting in March and re-entering in April? But the fact is, market made a bottom at the end of March and then started going up. And April was a great month. You would have also to pay taxes if you exit with some gains, and you wouldn't have enough time to reinvest it in other assets gainfully before the market trend turned. To say the least, you would have missed out the upside in trying to time the market on the downside, right? So we have to accept that volatility is part and parcel of equity investing. The best way to overcome it is to remain invested for a long period. We do it easily with real estate investments because we don't see a daily price movement. You hold a property for 10, 15 years. Keep in mind, all volatility and corrections won't be short-lived like what happened in March, April 2020. Some longer periods of volatility are going to test your patience. But time and again, we have seen that markets are also unpredictable in the short term. Have more faith in the long-term return ability of equity markets, but also always diversify within equities to smoothen out volatility further.
Yes, you're absolutely right. It can be very difficult to time the market. Many of my friends are asking me this question, should I stop my SIP? So what is your advice to them?
It's a hard call, honestly. Till when should you pause if you are pausing? How do you know in advance what the market will do, right? By pausing your regular investments, made through SIPs, you are actually reducing the probability of achieving your long-term goals, because the projection at the start would have been, okay, you have to make the SIP for so long, etc. And the long-term return depends on every day that you are invested, not just certain periods. So ask yourself, if you pause that SIP, what is the alternate use for that monthly amount that you were investing? Will it just lie in your bank? Are you going to spend it all? That's the real danger, isn't it? If you're not investing it for the purpose earmarked, which is long-term goals, then what are you going to do with it instead? Lastly, if the volatility is downwards, it means prices are correcting. And for the same amount of regular investment every month, you will get more units for the fund you're investing in. So all things being the same, like quality of the portfolio, your long-term goal, and your long-term return expectation, continuing your SIP through volatility or a correction means adding more of the same at a better price. So why not?
Yes, you are right, Lisa. But most investors are looking for some kind of answers. What the general advice really is that keep invested in the market, stay invested for long term. So I'm reminded about our previous podcast where we discussed about goal-based investing. So does having a goal-based strategy help address many of the questions that investors might have right now?
Honestly, let me just put it this way. So for individual investors who have limited means, rather than an unlimited pot of funds, the objective, obviously, as you were saying, for example, retirement. So the objective is not to follow the market and to maximize return. Rather, it is to achieve their own financial goals. See, if you have an unlimited pot, then you can risk as much capital as you desire, and hence you can chase return whether you are retiring or not. But when capital allocation has limits, or when you have to think about education, retirement, buying a home, and all the rest of it with a limited sum, then your focus cannot be on what the market is doing. Rather, asset allocation to achieve the goals is more important. So proper asset allocation allows for calculated risk, which can accommodate capital safety where needed and inflation beating long-term returns too. So the latter is the purpose of an equity portfolio. So say, for example, an annualized 12% return is also inflation beating, and 25% annualized return is also inflation beating, right? However, at 25%, you will require to take more risk and thus have a relatively lower probability of achieving that over a given period of time. Now, depending on how much of a priority your long-term goal is, how much time you have, and what your existing accumulated savings are, you can decide how much more risk you want to add. So like you were talking about retirement. So if retirement is very close, then you may want to pull out some of the accumulated wealth from equity and, redesign your portfolio. While you do need to invest in equity for the long term, the state of the market isn't the reason to invest or to exit. Your own goals and objectives should be your guide. If retirement is very far away, then regardless of the market condition, you may want to remain invested. Of course, if you are invested in equity, and volatility picks up when your goal timeline is close, say a year or so away, it is prudent to reduce the risk. You now no longer have a long-term runway, right? Rather, the timeline has shrunk to a short-term 1-year horizon. So de-risk and move the amount you need to a more stable return investment option so that the short-term volatility does not impact your ability to fund your goal.
Yes, Lisa. So I think what I could understand from this entire conversation is that, diversification really helps, and investors should focus on their goals rather than, market levels. Goal-based investment planning is really the key to managing your portfolio. Thanks, Lisa. That's all I had for today's discussion. And before we wrap up, here are my 5 personal key learnings. First one is that equity markets are always volatile, but the degree of downside volatility will vary all the time. So volatility helps in building long-term portfolios. Second one, avoid trying to time the market. You never know when the recovery happens. Frequent buying and selling can erode your returns. In fact, our internal study shows that missing even the best 10 days in the market reduces your CAGR return from 14 to 9%. So this is a study we done from 2006 to 2024. And that tells us that it's best to remain invested in the market. The fourth point is that diversify your portfolio into asset classes that have low or negative correlation with each other. This helps you mitigate downside risk from one asset class. And last but not the least, focus on your financial goals rather than looking at the market levels. Thanks, Lisa, once again for making this concept really easy to understand. And we hope our listeners will be able to handle the ups and downs of the market better now. We will catch you in the next episode soon.
I have to say, that was an incredibly informative episode, and I'm really glad we got the nitty-gritty details of asset allocation, diversification, what tools or instruments can actually help us gauge market volatility as well as brace for impact. It's always conversations like these that can reassure us and I guess give us the strength that we need as a collective to stay strong with our investments. So don't let the market volatility bother you too much. We are human after all, so these emotions are normal and expected, but don't let them get the better of you. Thank you for tuning in to this episode of Smart Investing by PGIM India Mutual Fund. That's a wrap for now. We'll catch you soon with another interesting conversation on how to make the most of your investor journey. So keep a lookout for that, but in the meantime, happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You are listening to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.